So let's talk about lecture note 2, which is going to be key to homework 2. So put the PDF online. All right, so the key to lecture note 2 is this is on the EIC framework, and the general idea is that for your group projects, there's going to be 4 parts of the group project. One of the parts is the external analysis, the economic analysis, and we're going to use the EIC framework. E stands for economy, I industry, C company, to do the external analysis. Okay? And if you remember on the first day of class, one of the comments that I made is approximately 50%, give or take, of the performance of a company is the industry that it's in. Well, the EIC analysis will help us understand that and how it's changing over time. Okay, so let's start out with the economic part of this external analysis. So the economic part of the analysis tries to understand the following question, which is how sensitive is a company to the economy, and basically is the economy getting better or worse over time, and what is the impact to the industry and company as a result of that. That's what we're trying to assess and understand in the E part of the EIC. Right? So for those of you that have been starting to do your certification under economic, you're going to start to learn about, in Bloomberg, some of the data that they have. So for example, if you start typing in EC and then you go to ECFC, this screen within Bloomberg aggregates economic forecast by country. So where EEO gives you the forecast of companies' earnings, the ECFC screen gives you the forecast of the country's economic data. So Bloomberg is aggregating the economic forecast by the economists and then giving you the consensus estimates for economic data, just like we do company data. So on the ECFC, you can see for the US, for example, historical GDP and the forecast for GDP for the next 3 years based on economic guesses by the economists. And then you can also see CPI. You can see, if you scroll down, housing data, labor data, such as unemployment rates. You can see interest rate forecasts for the US, exchange rate forecasts, etc. So you can see both historical and forecast data. And like any other screen on Bloomberg, you can drill down. So for example, economists expect the US economy to grow by 2.1% in 2017. If you click on the 2.1%, these are the actual banks that were surveyed, and this is the forecast by bank. And what was interesting that I found this morning that I had no idea is that the University of Maryland is actually included in this forecast. So there is some department here at this school, probably in the economics department, that their forecast that they're creating is being picked up by Bloomberg and used as part of the economic forecast that Wall Street is using for the US economy, which I actually thought was pretty impressive because I wouldn't have guessed, right? So, but nonetheless, you can see that there's 3 universities that are actually part of the forecast, and it's being weighted just as much as the Wells Fargo or the Goldman Sachs forecast. But nonetheless, these economists, which are giving the forecast, are aggregated and average, and this is the forecast for US GDP. So the point is, we're basically seeing about 2% growth in the US economy on a go-forward basis. Obviously, if we wanted to switch to a country like China, for example, we could actually see what China's growth rate is. It's slowing from 6.7% last year down to 6.2% by 2019. But nonetheless, here's where you can get the data on any country. So that's economics. So general idea is, China's probability of recession 10%, US probability of recession 15%. But point is, relatively low probability of recession for the US, relatively tepid growth, about 2%, but been pretty consistent with low inflation. Now, the other economic screen we're going to use is called ECSU, which stands for the Economic Surprise Index or the Economic Surprise Monitor. So let's click on this. So in the PowerPoint, what we used to do is there's a company called the Conference Board, and again, they do their own private research, and the Conference Board puts together something which they call the leading economic indicators. And what they've shown over time is the LEI index, the leading economic indicator index, is a really good predictor of when we're going to have recessions. So it's one of the closely followed gauges. And in this class, we looked at the LEI by the Conference Board as a proxy for future economic performance. But what Bloomberg gives us the power to do is, instead of just looking at one indicator for the Conference Board, they put that indicator and 42 more into an index called the Economic Surprise Index. And for example, the Conference Board Index is down here at the bottom, okay? That's the Consumer Confidence Index, or Leading Economic Index is right here. So that's one index, but they also have Consumer Confidence, they have Manufacturing Index, Retail Index, etc. So what Bloomberg is doing is they're aggregating, as I said, 43 economic indexes that are being forecasted by economists on a go-forward basis. And they put them into 6 categories: housing and real estate, industrial, labor, personal household income, retail wholesale, and then the surveys, things like the confidence survey, consumer confidence, leading economics, etc. And they then create an overall index, which they call the surprise index, based on how the economic data is reported against how the data is forecast. Okay, so just as an example, for factory orders on September 5th, economists had actually expected factory orders to decline 3.3% in the forecast period. When the data actually came out on September 5th, it was a 3.3% decline. There was no surprise. It was exactly equal to the expectation. On September 5th, for durable goods, the actual data of down 6.8% for orders was actually a negative surprise. It was actually down further than what people expected. So that's where the idea of the surprise index. Over to the right is what happened in trading on the S&P 500 right after this was announced, in the hours thereafter. So you can see what happened to the index. So the idea is this. General rule: a better economy means better stock prices because the pie is bigger and companies make more money off the bigger pie. A worse economy means a smaller pie, which means worse performance for the companies. So the second idea goes back to surprises. When the pie is unexpectedly bigger and prices are based on expectations, then the stock market should move up. And that's what Bloomberg is showing up here on the right. So on the right, they show the orange line represents the S&P 500 index over the last N number of years. And then the red and green are when we've had negative economic surprises, red, which means the stock market's probably going to go down when things are worse than what people thought. And green, when things are better than people think they're going to be, stock market has generally moved up. Well, Bloomberg is showing a correlation between those two. So again, what we're going to care about is not just what is the market going to do based on the economic data, but are there surprises, positive or negative, which means is the economy unexpectedly going to do worse or unexpectedly going to do better. So let's look at the Trump effect that's been in the headlines recently. So there's 2 views of the Trump effect. If you take the Trumpian view, all positive things are the result of Donald Trump's actions. All negative things are the fault of somebody else. Okay, so that's the view of the President of the United States. But if we take a more realistic view, then he is taking credit for all of the gains in the stock prices since he was elected. And people are calling this the Trump effect. What I think is actually happening, can be seen here on Bloomberg, is that since the election, there's been a bunch of positive economic surprises. So one could also say that people had a relatively pessimistic view of what was going to happen after the election in the economy. And the economy was actually doing much better than people thought it was going to be. And that's the reason why stock prices have been going up. And so that's the point, is that it's the good economic news which has been buoying the market, and that unexpected positive surprises has led to an increase in the S&P 500. By the way, if people start building in very positive forecasts going forward, and then suddenly we don't meet those very positive forecasts, the market could also fall. And that is what we saw happening in 2015 and 2016. So it wasn't that we were in recession, because you saw in the GDP data, the US GDP was still growing around 2%. Problem is, people thought the US economy was going to grow faster than 2%. The economic data was going to look better. It didn't. And that was actually the pressure on the markets at that point in time. So again, when we think about the economy, we have to think about the direction of the economy, and more importantly, whether the expectations are right or wrong. On a separate note, that's the whole point of why we're doing Stock Track this semester. What you're going to quickly find is, in the short run, the reason why it's very difficult to beat the market in picking stocks is because it has nothing to do with actual performance, it has everything to do with performance against expectation. Meaning you could make money, but if you don't make as much as people expect, your stock price will go down. Well, the same thing happens in the economic sense, is that basically if the economy is better, but it's not as good as expected, well, stock markets could still go down, right? Not because we don't have good data, but because people were over-optimistic and overpriced it relative to the actual. So the whole point of Stock Track, if you really want to win, is to get you to pay attention to expectations and to think about deltas against expectations. So for example, coming up next Tuesday, Apple in the Steve Jobs Theater is going to release the new iPhone. And there's a lot of expectations that are going into that. On Tuesday, we're going to find out what the hype is actually about. And then there's going to be adjustment in their stock price. But the real adjustment in Apple's stock price is going to happen 2 weeks thereafter. Because when the iPhone launches, the weekend after the iPhone launches, Apple's going to release a press release that Monday with how many sales they had over that weekend. And that is going to have a big impact on their stock price versus what everybody's expectations of how many iPhones that they're going to sell. In fact, you'll see in Bloomberg what those expectations are for number of iPhones that they're expected to sell, and then how Apple does against that will actually drive their stock price. So that's what I'm telling you. Your point of view in Stock Track around this is probably going to help you do better or worse in Stock Track than your other teams over the 3-month period that we're going to play. But nonetheless, same thing is being worked out here in the economic data. So what's happening with the economies for the companies that are in those economies, and are we getting any positive or negative surprises, and what does that mean for the companies? So now let's talk about what does it mean for the companies. So the proxy that we're going to use to help us understand what it means is something called beta. Okay? So what is beta? A company has a beta of 1. What does that mean? Yeah.
It means that it moves, it's like as risky as the market. So whatever the market moves, that's how sensitive stock is. Like less than 1 would mean it's safer than the market, more than 1 would mean it's like more volatile.
Okay, so that's a good summary definition. So let's apply this to the economic analysis we're going to do. So we're going to use what I'm calling a transitive property. So if a company has a beta of 1, that means they're kind of moving up and down with the market. And if the market has an average level of economic sensitivity, therefore by transitive property, the company has an average level of economic sensitivity. So companies with beta of 1 have an average amount of economic sensitivity. That's the transitive property assumption we're going to use in this class. If a company has a low beta, 0.5, that basically means it's not going to move up as fast, it's not going to move down as fast. Proxy, it's not as sensitive as the economy to changes. All right, so low beta stocks shouldn't change as much as the economy because those are stocks that don't change as much. They're the much less volatile stocks. And as a result, those companies are, we're going to say, are much less sensitive to economic conditions. Where high beta stocks are going to be much more sensitive to economic conditions because they're going to go up faster, they're going to go down faster than the market. So beta is our proxy for economic sensitivity. Okay? So here's the thing. Let's say that we are worried about the U.S. economy. Right? We think that the economists here might be wrong, and the Fed could really raise interest rates, and you'll see that there's now something called a volatility index, which you can actually look up in Bloomberg. The volatility index is spiking. There's a lot of uncertainty in the marketplace. So I want to be a low beta portfolio because I just don't want to take the risk. Okay, so that's the point, is that if I'm worried about the economy, low beta stocks are a hedge against the uncertainty of the economy. Or maybe the other way, which is I think the economy is going to take a fall. Therefore, what are the high beta stocks that are going to be most sensitive to changes in the economy? companies like airlines, companies like travel companies, to some degree the banks. Those are the higher beta stocks that when the market starts to get worse are probably going to be hit faster than the other companies. So this needs to be our thinking as we start forecasting companies and thinking about their valuations. So let's talk about it in terms of the practical homework assignment that you're going to have using the continued example of United Health Group, which we started in the last class. So let's go to Bloomberg and let's type in UNH, US equity. And let's understand how Bloomberg calculates beta. So once you get to a company, you can actually type in beta, and Bloomberg will calculate a beta in real time. And so the method that Bloomberg uses is it defaults to a 2-year beta on a weekly basis. So in this case, it'll take United Health Group on a weekly basis, change in stock price, and it will take the index of the country that it is in this case, the S&P 500, and it'll say for the same week, here's the change in the S&P 500, plot those data points. So we'll have 104 data points over 2 years. It'll draw the trend line, and basically the slope of this line is the beta. So based on the last 2 years, the beta of United Health Group is 0.861, right? So does that mean that United Health Group is more or less sensitive than the average company in the S&P 500 index? I'm sorry, less. So they're 86% of the sensitivity of the S&P 500. Therefore, we're going to say, if we're thinking about the economic forecast, they're a little bit less sensitive than the average company. And so therefore, when we think about it, they're going to be impacted, but not as much as most companies, which means that their cash flows are probably a little bit more predictable than some of the other companies when we start thinking about our forecast. Right? Make sense? Questions about that? Right. By the way, you can adjust this. If you want to do a 5-year beta, you can switch to 5 years. If you want to do daily for 5 years, just click daily. It'll add the extra data points. If you want to change the index, like instead of doing UNH against the S&P 500, you can do it against the Morgan Stanley World Index. And it will do the beta against the Morgan Stanley World Index as opposed to the S&P 500. And that's going to be important, for example, if you do an international company. So, for example, if I work with a company called Santander, Banco Santander, by default, Bloomberg will regress it against the index of the company that it's in. But the index for Spain that Banco Santander is regressed against has about 30 companies in it. And Santander is one of the biggest companies in Spain. So in a way, if you do Santander's beta, it's almost like regressing against itself. And so therefore, it's not as good of a metric because there's just not enough data points in Spain to regress it. So in this case, we actually would use something like the Morgan Stanley World Index to regress a company that's in a small country against a more broad-based index than the index of that country. Now for the US, most people think the S&P 500 is acceptable, and so therefore for US companies, it will default to the S&P 500 index. Yes?
So if you're comparing companies that might, data might be regressed based on different indexes, is that a useful tool?
Less useful. So in our case, as I said, what we'll do is we'll use the index of the country that they're in. So for your purposes, you're going to be doing it for US companies. But if I'm doing, like I said, global companies, what I'd recommend is instead of using the default Bloomberg, like you might even go in and do MXWO, because that's pretty common for the world index. But when you do your group projects, I'm not going to let you do an international company. You're pretty much going to do a US company because I'm trying to simplify it. But that's a good point, is that you want to make sure you are looking at apples and apples. Because the flip side is, if I'm doing China, like I should be doing China companies, but I should also be looking at the Chinese economy because the Chinese economy is different than the US economy. So I don't want to have an apples and apples comparison. Okay? All right. So, but here's the thing. Let's go back to United Health Group because that is the example we're going to use. There's a screen called RV, and on the RV screen is where you can compare peers. For comp source, the peer group, I want you to use the Global Industry Classification Standard called GICS. Okay, just a way of standardizing competitors. And region should be country of domicile, which basically means a U.S. company would be other U.S. companies as opposed to the global list. Okay, so that would get you this list of peers for United Health Group. Right now, over here on the right, you can click on custom, and that's what we had done when we went through the first examples of like the oil industry. But I mentioned Bloomberg actually has some predefined templates. One of the templates is called markets. One of the subtabs of markets is called beta, and Bloomberg actually does a real-time beta calculation for all the companies here. So these are the betas of all of the peers of United Health Group. Now the top line is a market cap weighted average. The way you get the top line is you go into settings, global settings, and there's statistics. Make sure market cap weighted average is checked. If it's checked, every time you go to a screen, it'll put it across the top. So for example, one of the statistics is standard deviation. So if I wanted to see standard deviation, check the box, close it, and then every time I go into the screen, it'll give me standard deviation in addition to market cap weighted average, if that was important for me to see. Now for our purposes, I care less about standard deviation. I care more about the market cap weighted average. So I'm going to take out standard deviation. But that's how you get it across the top. So that's the idea of this is the industry beta for these peers and the market cap weighted average, and then the United Health Group's beta. Okay. So finally, Bloomberg has something they call the raw beta and the adjusted beta. Okay. And that's just a statistical religious argument. So the idea is that the raw beta is the actual slope of the line. Okay. Where the adjusted beta, statisticians believe in putting in a regression coefficient to move the beta closer to the mean because they believe in regression to the mean over time. So the adjusted beta is basically 2/3 of the raw and 1/3 of 1. So all they're doing with the adjusted beta is moving the beta 1/3 closer to the mean. Okay, and that's called the adjusted beta. When Bloomberg does CAPM, they use the adjusted beta by default. Okay. For purposes of the E and the EIC, I'm going to arbitrarily tell you that I want to use the raw. Because the question we're trying to answer is how sensitive is a company to the economy? And so therefore, the raw is the actual change versus the market over time. So I think the raw better answers that question. And regardless, we're going to just all choose raw for purposes of homework 2 and your group project. So use the raw column. And as you're answering homework 2, you're going to have 2 questions coming up on homework 2. It's just going to be a different company, right? So question number 1, is United Health Group sensitive to the economy? How would you answer that question? Given the data we see on the screen. Is United Health Group sensitive to the economy? Yeah. That's right. It is sensitive. It's 0.86, but it's 86% as sensitive as the average company. Very important in this class, you need to reference data. So include the 0.86 in your answer, because otherwise you could just be flipping a coin without ever having to go to a Bloomberg terminal. Right? And that's not acceptable for answers in this class. So you have to support the data so we know what data you're using to answer the question. So in this case, because it has a beta of 0.86, it's a little less sensitive than the average company. Part 2, what about the industry? How does United Health Group compare to the healthcare industry of payers? Yeah.
More sensitive.
Why?
Well, the raw beta of the weighted average is 0.78 and United Health Group's 0.86.
Exactly. So that's the other thing. So United Health Group is in an industry that's also less sensitive. However, United Health Group is actually a little bit more sensitive to the changes in the economy than the average peer in their industry. And that's what I'd also want you to understand. Yes?
Are all those companies listed on that list like peers of United, or is it possible that there could be some skewing of the data?
There's some skewing in the data, but as I said, it's based on the Global Industry Classification Service. So that when the companies listed, they were put into an industry category And so, if nothing else, this is the healthcare sub-industry that United Health Group is in. So later, when we get into multiple analysis, we might refine the list. But just for getting started to keep it easy, I'm just going to use the GICS comparison. So they have some at least loose affiliation to healthcare companies. Right? Good question, though. Other questions? Okay, so that would be how you would need to answer the question. Now, by the end of the semester, I would expect you to know the following. The reason why United Health Group has a higher beta than their peers is because they are about $185 billion worth of revenue last year, but $80 billion of their revenue approximately is a business called Optum. And I actually just wrote an article, it's going to be published this week, but basically what it says is Optum is the biggest healthcare company you've never heard of, right? Because Optum basically is kind of like, think of it as, Optum is like an Accenture-like business completely owned by United Health Group. So they have two businesses. They have United Healthcare, which is the largest insurance company in the US, and payers. And they also have this business, which is a consulting outsourcing business. So for example, if you call Aetna or Cigna and you actually ask about your insurance, you're actually talking to a call center managed by United Health Group, and it's private labeled out. They actually sell data services. They sell claims management processing. They manage the websites. They manage all of the analytics. They have artificial intelligence. That's what they do. You think Watson does AI? United Health Group is far bigger in the healthcare industry than IBM. So they're an $80 billion business growing about $15, $20 billion a year. The other thing that United Health Group has under their Optum business is that they have a part of Optum called Optima Health, which last year was $15 billion. It's direct-to-patient services. So basically, said another way, United Health Group is the 8th largest hospital in the United States today. And people have no idea that they've actually been buying hospitals, they've been buying surgery centers, they've been buying oncology centers, they've been buying physician networks, they've been buying nurses, they've been buying minute clinic type places, and they actually, instead of outsourcing or running the back end for hospitals, they're literally owning and operating them themselves, to the point that they have $15 billion of direct revenue for hospital services. And United Healthcare is actually reimbursing their Optum business for doing this rather than reimbursing the hospitals, and they're better than the hospitals at doing this. And so their new strategy is that, according to Jeffries, what management has told them is this business by the end of the decade is going to be $150 billion, just the hospital segment, which means they will be the largest hospital in the United States in the next few years. And that's without acquisitions. The largest hospital system in the US today is about $60 billion. So they're going to be 2 to 3 times the largest hospitals today within the next decade. And again, nobody's even heard of them as a hospital-like system. And so if you want to think about the transformation of healthcare, these guys are on the front lines. And this is a huge amount of growth ahead of them for a company that's already $186 billion in revenue, and they're transforming healthcare as we know it. So here's the point. That's why their beta is higher, okay? Because they're getting into these private services in addition to just becoming the insurance payer, which the other companies on that list are primarily just the insurance payers. So that's why their beta is higher. So what I'm telling you is, if this were your group project and we're near the end of the semester, I would expect you to explain what I just did. All right? Right now, I don't expect you to know a lot about these companies, but you're going to get there over the next 3 months. And this is what I mean by knowing the stories behind the numbers and using the numbers to kind of infer the data. Right? By the way, I don't think the market has completely picked up on this. This is StockTrack, okay? Because if you look at StockTrack and you look at their revenue estimates, they were 185 billion last year, 200, 218, 236, 251. That's $70 billion worth of growth, but I'm telling you, it could be more. All right, as big as that looks, because if they do acquisitions on top of what we're saying, and they're already expected to grow to 150 billion, what the Jeffries analysts have said is that, so I'm not giving you, because I work with them and I'm also under NDA, so I have to be careful what I say. But what the analysts have said publicly, but has specifically said that their revenue could actually be even bigger if they're successful in this mission as transforming the hospital segment. And by the way, that's only a $15 billion part of this $186 billion today. Okay, so again, this goes back to stock track. If people really haven't picked up on that, then their stock price has a long way to go. If people have picked up on that, then their stock price might not be as good an upside. But here's the point. As of today, buy, sell, holds, 19 buys and 1 sell. And the only person that's a sell is a guy that works for Morningstar. All the banks love him. Okay, so again, this is what you would do in stock track relative to the type of analysis we're going to do. But this is a further afield than the EIC part of the assignment. This is just the E. Questions about the E. So back to the beta. RV, markets, beta. Make sure market cap weighted average is on there. The company I assign you and the industry, talk about whether it's more or less sensitive to the economy. Screenshot, up top, take screenshot, save, name it whatever you want, UNH RV. Because you're going to have to upload the screenshot for your homework assignment as well. Okay? Second section of EIC. I, industry. In this class, the definition of an attractive industry is going to be based on spread. Positive spread, attractive industry. Negative spread, unattractive industry. Spread is the difference between the industry ROIC and the industry WACC. Okay? Again, go back to Bloomberg. In the RV section, custom. You will type in, add column, ROIC, return on invested capital, latest filing, enter. WACC, WACC, enter. The difference between those two is called spread. Now, what you're going to learn on Monday from Bloomberg is you can actually come in here and create your own custom formulas that don't exist in the Bloomberg database. And homework 3 is I'm going to give you 10 custom formulas to add to your Bloomberg account. They don't exist now. You're going to learn how to create and do them on at the Bloomberg training. So here's the point. What I have done is this is the screenshot you will need to take. You have the ROIC WACC, and the spread is the difference between the two. I actually have a custom field called spread, which is ROIC minus WACC. Okay, so it makes my life easier, so I don't have to do the math in my head. I can just see this minus this equals this. But you're going to do a screenshot with these two because you're not going to have spread for this assignment. Unless you want to be ambitious, try to create yourself. But regardless, given the definition, question 2 on your homework assignment, is this an attractive industry? Yes or no? Is United Health Group in an attractive industry? Yes. Why? Because it has a positive spread of 3.2%. That's the answer to the question. Okay? Now, here's the thing. Definition of competitive advantage, which will go into the C side. What I want you to keep in the back of your mind is there really is an industry level of return. Some industries are more attractive than others, and the return that you're going to get is going to be somewhat based on the industry that you're in. So again, looking at this list of payers and looking at these spreads, basically the ROICs are not too dramatically different from each other. Cost of capitals are pretty similar. So they're all going to kind of earn somewhere around 10% plus or minus a little bit. And what I'm saying is the plus or minus is the competitive advantage. So in this class, we're going to use a different definition of competitive advantage than you may have previously learned. All right? In previous classes in the real world, everybody's good at something. Okay? We don't do that in this class. in this class, performance against peers. If you have competitive advantage, it's because you're outperforming your peer group, right? So if you're in a good peer group, that doesn't give you competitive advantage. It just means you're in a good industry. It doesn't mean that you're necessarily creating better value than somebody else in the industry. So to really show advantage, you have to be doing better than the average. So in this case, spread. Given that definition, does United Health Group today demonstrate competitive advantage? Yes or no? And why? Because their spread is higher than the industry average. Specifically, United Health Group's spread is 4.5%. The industry spread is 3.2%. Therefore, they demonstrate competitive advantage. Does everybody see that? Does Anthem have competitive advantage?
No.
Does Anthem create value?
Yes.
So it is possible to create value, have a positive spread, but not have competitive advantage. That's the definition application we're using. So what I'm really saying is Anthem's doing okay because Anthem is in a good industry. Anthem is not doing okay because they're better than the peers within the industry. Does everybody see the distinction? Does Cigna have competitive advantage?
Yes.
It is possible for more than one company to have competitive advantage. Okay? Let me switch to a different industry. We talked about autos last week. Here's Ford. Is the automobile industry, given its spread, an attractive industry today? No, it is not, because it has a negative spread. Does everybody see that? Okay. Does Ford have competitive advantage? No. Does Honda have competitive advantage?
Yes.
Yes. Does Honda create value?
No.
Therefore, using our definition, it is possible to destroy value yet exhibit competitive advantage. That's Honda. So here's the point. Honda is in a lousy industry. They're good at what they do, but they're still in a lousy industry. So that's the point. Anthem creates value because they're in a great industry. They're not as good as some of their peers. They don't have competitive advantage. Honda can have advantage. You can have advantage while destroying value. You just destroy less value than your peers because you're better at what you do. That's the way I want you to think about competitive advantage. So it's position relative to peers. Questions about that? Okay. All right. So back to the assignment. So everyone is going to take a screenshot of that RV screen with the ROIC and the WACC for the industry, for the company that I give you that I haven't given you yet for homework 2. I'm not going to post homework 2 until the end of the day because I don't want people to do it during class. So you'll have a company, you'll have to do the E just like I did, take a screenshot of the beta for the industry, talk about the economic sensitivity of the company in the industry, and talk about whether it's an attractive industry and whether the company has competitive advantage. But because we're doing valuation, as I said before, the difference between finance and accounting is we tend to care more about the future cash flows, not the historical cash flows. So what I care about is not the spread today, but what I really care about is the spread tomorrow. And specifically, we're going to define tomorrow as in 5 years. So the real question, part 2B, what is the spread? We'll use autos as an example of the automobile industry in 5 years going to look like. So right now, the auto industry is a tough industry. It's at negative 1.3%. Is it going to stay that way in 5 years? That's the question you're going to have to answer. To answer this question, you're going to have to explain the industry spread. And to do that, we're going to use the Porter 5 Forces framework, which you guys all know from previous classes, as the model to explain spread. So power of buyers, power of suppliers, availability of substitutes, barriers to entry and exit, rivalry. Using those 5 forces, you have to explain the industry spread today. You have to write that out. And based on your view of how those forces will change over 5 years, you're going to make a prediction for what you think the spread's going to be in 5 years. That's going to be key to your next upcoming homework assignment. Now, 2 very important points about this. When we did this assignment in an MBA version of this class I taught 2 years ago, I got into an argument with one of the MBA students. I felt bad for the guy. He got a 0 on the assignment. I wasn't being vindictive. He just wasn't following the rules. And what I realized is this might affect you, so I'm explaining to you now so it doesn't happen to you. What we're now seeing in society in general is people are using bias rather than facts to make determination. And it's getting really bad. And so that's the point. In this class, I want you to make determinations based on what you see, not based on what you think you're going to see. Okay? So therefore, bias is bad. And I'll give you an example of bias. So the assignment at the time was on the airline industry. And I was like, what is the spread of the industry going to be in 5 years? How good is the industry today? How good is it going to be in the future? It's a 500-word assignment that you guys are going to have to do to answer all these questions. He wrote 500 words. He got a 0 on the assignment. He was pissed off. I gave him a 0 for writing 500 words. He thought he should get credit for it. His whole answer was the airline industry sucks, and it's going to continue to suck in the future because it's a horrible industry. Why would anybody want to invest in this terrible, horrible industry? Because blah, blah, blah. And he talked about why the 5 forces were bad. Well, the data hasn't changed all that much. Let's pick Delta Airlines as an example. This was approximately the data he saw. And he was saying, the airline industry sucks. And I'm just like, no, it doesn't. It's actually a really good industry now. It's actually better than the healthcare industry right now for the payers, right? He couldn't get past that. He's like, I don't care. It's been a horrible industry long term. And that's the point. Yes, for a long period of time, the airline industry was a bad industry. And he did the Harvard Business School case in a previous class on Southwest Airlines from like 2007 when it was a terrible industry. But that's not today. It's not 2016. That's not the data we see in front of us. And that's the next thing. I can't say with this data that the buyers have so much power and so much choice, that the suppliers have complete control over this industry, that it's so easy to start up an airline, that there's tremendous amounts of rivalry, because that doesn't explain how this airline industry, and particularly Delta, are making those returns. So even when you write up the 5 forces, it goes back to, you can't just write bias, you have to actually explain what you see. And that's going to be very important this semester, is that we actually have a tool which gives us access to data, 900,000 assets in almost real time. And we have expectations for a lot of those. And I want us to use the actual data you see, not your biases of what you think you should be seeing. Because that's what's going to get you in trouble, not only in this class, but I think in the real world. So as you do these assignments, starting with this ones, make sure you actually look at what you see and write up the 5 forces based on what you see. Yes? It'll be on the industry, not the company. Because the company is within that industry. So in this case, I would be talking, even if the assignment was Delta, I would be talking about the airline industry that it is in. It's the rivalry for the airlines, not the rivalry of Delta. Of all the airlines. Good clarification. Now, for the C section of EIC, you're now going to talk about Delta. So let's go back. Does Delta demonstrate competitive advantage? What would the answer be that one? Yes. So Delta's doing something that's giving them competitive advantage. Why? And here's the more important question. Let's think 5 years out. Okay, so now we're 5 years out, thinking about 5 forces. What's going to happen to the airline industry in 5 years? Is the airline industry going to have a positive spread of 5.5% in 5 years? We have to answer that question as part of this assignment, assuming Delta was our assignment. Is the airline industry going to have a positive 5.5% in 5 years? Your bias should be no. And the reason, based on the readings in the book, should be based on different industries have different attractiveness. But this is the table I referred to last week that was in the book that I put in the PowerPoint that shows regression towards the mean of ROICs over time. So the data should tell us that nobody maintains good returns forever, and in 5 years, we should expect that spread as an industry to start to compress. Now, it may not turn negative, but it shouldn't be as good as today. Now, can there be an exception? Yes, there can. But that's what you would have to explain. Okay? So the first question is, what do you think is going to happen to the airline industry? Well, maybe the answer is it'll still have a positive spread, but maybe not as much. And here's why I think so. Then the next question is, what about Delta? Delta's earning about double the spread of the airline industry today. Are they going to have double the spread of the airline industry in 5 years? What's the answer to that question? Because that goes back to their competitive advantage. Will Delta still have a positive spread above their peers? So maybe it's not as much, but will it be positive relative to their peers? Will they still maintain competitive advantage? Because that's got to be part of your answer to the question. You have to give your opinion somewhat fact-based on that. So I'm going to guess that at this point in your early undergraduate careers, you probably don't know a lot about these companies. So 2 sources of data to help you with the assignment. One, if you go to ELMS and scroll down, there's something called VBIC. And if you click on VBIC, there's the Online Resources of Maryland. And one of the Online Resources of Maryland, under VBIC, is industry. We have a data service called IBIS World. IBIS World is a data service that writes industry research reports. Now, it's funny, last semester somebody said, these reports aren't really that great. And I was like, we're Maryland. We're lucky to have a service at all. Like the state legislature is cutting our budget every year. We barely have money to pay for faculty and staff and things. The fact that you have this, enjoy. Okay. So yes, you work for Goldman Sachs. You probably have better industry writing report data services to look at. You're at the University of Maryland. We're going to use what we got. So what we got is IBIS World. And IBIS World does industry research reports. So the way it works is you type in a company or an industry. So in this case, let's type in United Health Group. Search. And we subscribe to their research reports for the US, Canada, China, and global. So if the company's in multiple reports, you'll see the reports that they're in. In this case, health and medical insurance, probably their primary business. I'll pick that one. I can download this as a PDF. But here's the point. These IBIS research reports basically do the 5 forces analysis for you. So in this class, because I'm asking you to use real data to make real predictions, it's okay to use real sources to help you do that with the following caveat. So again, last semester, it is okay to use the data source, just don't plagiarize, right? We're in an academic institution, plagiarism is looked at unfavorably. So I had a student last semester that literally took the IBIS report and cut and pasted it into his paper and didn't reference anything. When it went in front of the Honor Council, he got an XF. Okay, which basically means it's a failing grade for academic dishonesty. It's going to be really hard to get a job with that on your transcript. And his parents blame me for this, okay, because the student was idiotic enough to cut and paste and didn't reference anything. So whatever, son's an idiot, but the professor is the one responsible for making him do dumb things. So I'm just letting you know in advance, it is okay to copy as long as you reference and cite. It is okay to use work, just don't call it your own if it's somebody else. So that's the point. You're going to need to use the IBIS reports to help you if you don't understand the company. That's okay. Even taking a quote that an analyst said is okay, but quote it, reference it. Don't call it your own. That's the line you can't cross in this class, but you will need to use other data, so source it. Sourcing is perfectly acceptable and probably necessary. I'm just saying this because I want to be really clear on expectations because I don't want you to get across these tripwires. Yes? I mean, you guys know how to cite at this point. My preference is that you're citing. I mean, I'm less worried that you do whatever, I don't even know the formal thing of citing, but the fact that you've cited it and said it's somebody else's is much more important to me. What's going to get you in trouble, as I said, is when you literally, and it was really hard for the guy to explain in front of the Honor Council, because he actually challenged this in front of the Honor Council, And then he actually went to the hearing, and right before the hearing, he decided to plead guilty because it was really hard to prove that the entire page from IBIS World that he had copied verbatim and pasted was actually something he wrote originally. And so his penalty was actually going to be worse if he'd actually gone through than the XF for the semester. So I'm just telling you, it's not worth it. And so I'm not going to send you to the Honor Council if you cite something. So if you just said, IBIS World Report, use this as a source, blah, 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 and it wasn't formally written, I'm not going to nail you to the wall for that one. But if you don't source anything and you cut and paste, that's going to be really bad for you as part of an academic institution. So just be really clear about that. You should already know this in your career. Just reminding people because people do dumb things and tend to forget. So, matter of fact, here's another dumb thing you don't do this semester. Every screenshot you take in Bloomberg has a serial number and a time and date stamp on it. It is impossible to take two screenshots of two different screens that have the same serial number and time and date stamp. If we see in the same assignment that's an individual assignment, the same screenshots that are being reused, you're going in front of the Honor Council with an XF for the semester. So again, do not use somebody else's screenshots to do your assignment. I would hate to see somebody fail the class because they did something really dumb. So when I give individual assignments, you have to do it yourself. Okay, very, very clear, and it's really easy to be tripped up by that one. So don't use somebody else's screenshots. Yes? I'm sorry? You can take phones of, if you can't take screenshots, you can take a phone image. That's fine. It's kind of like a screenshot. It's really easy to take screenshots, though. Okay. But as a matter of fact, if you take a phone image, definitely don't share that with somebody else, because that one's going to be really obvious that that was actually shared. All right. So back to this. So IBIS World particularly has data across the tabs. The other thing it's going to have is key statistics at the very end. It actually has industry growth rates for the future. So when we start forecasting the cash flows of the industry and the companies, we will use some of these industry forecasts to help us understand what the industry growth rate is going to look like in the future. So that's the other benefit of IBIS World. Okay, so let's go back to our homework assignment for the class. So to be clear, EIC. First, E. What you're going to need to do is you're going to have to take a screenshot of the beta under the RV screen using GICS, country of domicile, for the company that I give you. Make sure you put in the market cap weighted average off the global settings within the screen so that you talk about the sensitivity of the company and the industry that it's in relative to the economy. I. Go to the RV screen. Take an RV screenshot. Again, RV, if I were doing airlines, custom, GICS, country of domicile, column, ROIC, latest filing, WAC. There's only one WAC. Hit enter. It's current WAC. The difference between the two is the spread. Is this an attractive industry? Yes or no? What would our answer be? Yes, because there's a positive spread of about whatever it is, 6%, 5 point whatever percent. And then the question is that spread going to be better or worse in 5 years? We're going to use the 5 forces to explain why it's positive today, and we're going to talk about the change in 5 forces that could cause the spread to change over 5 years. Our bias should be this, but there can be exceptions. Now, where I don't want you to use the bias is the observable data for today, meaning look at how the industry that I give you is performing. Don't use your impression of whether or not you think it's a good industry. Look at the observable data, right? And then define whether it's going to get better or worse over time. C, competitive advantage. Again, using the RV screen. Does it have a better spread than the industry? Why? And more importantly, will it change over time? Okay, so that's really what the next assignment is going to be about. So after the last class today, homework 2 will be updated and posted. And then again, we'll be due at 10 a.m. on Monday for all sections. The rest of the day on Monday, be on homework 2. Bloomberg is going to be here to do training, and show you this plus more. Now, the other source of data, which I didn't get to, but if you do certification, might help you with the 5 forces analysis, which is actually better than IBIS World in my opinion, is BICO. Okay, so if I go to United Health Group, as an example, BI stands for Bloomberg Intelligence. BICO is Bloomberg Intelligence on the company. And they have an industry tab, and they typically have a company tab. Okay, so what Bloomberg has been doing is 2 things. One, they're hiring sell-side analysts that used to work for the banks to directly work for Bloomberg and write just industry research on what's going on with the industries and the companies, and they're publishing it within the terminal under the BI section. 2, they are taking Bloomberg News and they're aggregating all the information and data gathering from the Bloomberg News network, and they're putting it into the Bloomberg terminal, and again, curating it according to the industry. So this is also where you'll get a really good source of what's happening with the industry and what they think is happening over time. So your 2 sources, IBIS World and BICO, B-I-C-O, or BI Bloomberg Intelligence. That's another source of getting data about the companies. As I said, please use real world data to help you. Don't feel that for the company and industry you don't know anything about and you don't know how to write this. You can use these data sources, just don't plagiarize. Put your references in. Okay? And then the third part is competitive advantage, performance against peers, which again, you'll use the RV screenshot to do. Make sure you take your own screenshot for the beta and your own screenshot for the industry performance. Okay? Other than that, have a great weekend. See everybody on Monday.